There are a lot of people playing audit roulette, right? So, audits are very, very rare. Only 1% to 2% of all, taxpayers face random audits. And so people play audit roulette and they just take their chances and, the odds are in their favor. But if you do, the IRS would disallow it and you'd have to, fight with them.
All right, so welcome to the Millionaire Enlisted Podcast. Today with Michael Brady. He is a 1031 exchange expert, and just let's dive into today's subject, Michael. So please let us know in our audience what is it that 1031 exchange is, and how do you do it?
Yeah, sure. So just briefly, I actually am an attorney by training. And got involved in the qualified intermediary industry in 2005, and I've been doing that ever since. Qualified intermediaries are kind of an integral part of the 1031 exchange process. In our company, Madison Exchange, Madison 1031, we go by both. We do 1031 exchanges nationwide. So what exchanges are designed to do is to allow real estate investors to defer paying capital gains taxes when they sell a piece of property at a profit. Right. Typically, if you sell, something that with a capital gain, and it's if it's a property held for over a year, the capital gains tax rates between city, state, and the federal government winds up being about a third of your profit. So the 1031 exchange, which has been part of the tax code since the 1920s, allows you to take the proceeds from your sale and roll it over into a new investment property, and therefore defer paying the capital gains taxes. So essentially, you're going to be able to take tax-deferred money and buy bigger and hopefully more profitable property.
That's awesome. So let me ask you more a little bit about you. Is this your company? Did you get invited into a company? How did you start off?
So Madison Exchange is actually part of a much larger company. So Madison Exchange is a division of Madison Commercial Real Estate Services. That company has a title insurance company called Madison Title, which is one of the largest independently owned title insurance companies in the country. And we also have a cost segregation company called Madison Specs, which helps investors accelerate their depreciation. So we are part of a much larger company. I had worked for a couple of different companies in this field over a number of years. And I joined Madison about 2 years ago to kind of head up some of the sales and marketing efforts and to structure some of the more complex exchanges.
Got you. But so you handle, as an attorney, you handle more of the legalities as opposed to what a CPA is going to handle on the 1031 front, correct?
Yeah, I mean, essentially, I am an attorney, but our role in the transaction as the qualified intermediary is to just be the qualified intermediary. So we're not permitted to give tax or legal advice. If we were the taxpayer's own accountant or attorney, we could not do what we do under the regulations. So they still need their professionals, but we have a certain expertise in this because this is all we do, right? So we do several thousand transactions a year. In my career, I think I've helped investors defer over $1 billion in taxes by using Section 1031. And so, we provide guidance to the taxpayers, tax and legal experts, their attorneys and their accountants.
That's awesome. So as far as you being a third-party entity that is holding that 1031 in escrow per se, how are you providing security to the individual who's doing that 1031? I'm sure you're aware, there's tons of scams out there. Regulation on 1031 intermediaries is not as regulated. Right. So how are you handling that part to bring that?
Yeah. And that's the most important question you can ask whenever you're selecting a qualified intermediary. Number one, we are a largely unregulated industry. As you said, there's a handful of states that have some minimal regulations of qualified intermediaries. And there were some problems back during the financial crisis with companies who, were not able to fund their exchanges for a variety of reasons. So typically you want to ask, number one, where does the money go? Because we handle and we hold proceeds on behalf of our clients between their sale and their purchase. So we set up, basically put all the money into escrow accounts, right? So we typically have a master account under Madison Exchange's name, okay? And then we have sub-accounts for our clients that bear their name and tax ID numbers. So the funds are segregated and identified at the bank for each particular client, which is very, very important when there are, potential bankruptcy issues. Additionally, we're part of a much larger company. So we're quite frankly, the smallest part of Madison Commercial Real Estate Services. And so, we have some financial backing as well. Additionally, we are bonded. We're bonded against any kind of employee theft or mismanagement. And we have errors and omissions insurance as well. And lastly, you also want to make sure that any company you're dealing with has some expertise in 1031 exchanges, because really anybody can be a qualified intermediary. So, we have 3 attorneys on staff that are dedicated to 1031 exchanges. We have some accountants on staff as well. And we have 3 certified exchange specialists as well, who have basically proven a minimum level of proficiency by passing a test given by our trade organization, the Federation of Exchange Accommodators.
Awesome. So let's dive a little bit more, if we can, into the 1031 process itself and how an investor can benefit from a 1031.
Yeah, so anybody that had, first of all, it's important to note this applies to investment real estate, right? So your primary residence is not going to qualify for a 1031 exchange. This is only for, your rental property, a property that maybe you operate a business out of. It could apply, to even vacant land, as long as it's held for investment purposes. So essentially, you need to sell that property to a third party and roll it into another investment property. And we essentially handle the middle part. So before they do anything, they need to contact us to set up the closing. We take assignment of their contract of sale so that when they close, the proceeds will come to us. They then have 45 days to identify the property they want to purchase and up to 180 days to close on it. Okay. Once they find the property, we take assignment of that contract and we essentially just fund the purchase so that the deeds on each side go directly from seller to buyer. But for tax purposes, it is viewed as if they just traded one property for the other.
Gotcha. Okay. And then as far as the time limit, I get, is the IRS regulating that, or is that kind of like a self-regulated timeline?
Yeah, so we don't report anything to the IRS, but these are hard, fast deadlines. So the taxpayer has to make sure that they meet them. We do police them religiously because, our reputation is on the line. We have to make sure we abide by the rules. So, that 45 days is a hard, fast 45 days. And 180 days likewise, and this is business days, calendar days, not business days. So it goes pretty quickly.
So this seems like a very stressful process, according to the timelines and the deadlines. Are there any extensions in case those deadlines are not being met? Because we've done several transactions as well, and a lot of times those deadlines don't meet because of the whatever is going on the seller side, or whatever is going on the inspections, or whatever the case may be. So can you explain more on that?
Yeah, sure. So there are no extensions. The only time the deadlines have ever been extended is when either the taxpayer, their property, or their accountant are located in an area that's impacted by a federally declared natural disaster. Right. So, in California, there have been extensions for the wildfires. In New York, we had a big extension for Superstorm Sandy. Colorado, you get blizzards, so those various things are reasons why you might get extensions. But otherwise, they're hard, fast deadlines. So if your 45th day is Thanksgiving, well, you have to identify the property by midnight of Thanksgiving, despite the fact that I may be watching football half unconscious from a tryptophan coma from the turkey I ate all day. You still got to make sure that you get that identification.
Okay.
Can you identify one property or an asset and then, find a different asset and change your mind and still meet in the same timeline?
Yeah, so the way it works is you can identify alternate properties. So you can identify in the 45 days, you can identify up to 3 potential replacement properties regardless of the value. Okay, so that means you could, identify several, properties about the same size as the one you sold, or you can identify several small properties and buy multiple properties. And that's perfectly permissible. And then if one falls out in the, after the 45th day, you just go on to the next one. You can exceed the 3 properties provided the value of what you identified does not exceed double the value of what you sold. Okay, they call that the 200% rule. And that's if you sold for $1 million, you could identify 4 or more properties, provided the total value is not more than double, or $2 million in this case. Okay, so that allows you to kind of keep your options open. But after those 45 days have passed, you are locked into whatever you've identified by that point.
Gotcha. Okay. And then, sounds like a great strategy to defer taxes. Is there any cons? Anything investors should know as far as when it's not advantageous to do this?
Yeah, well, first of all, you want to make sure that that your plan is sound, right? So, sometimes people get confused on how much they need to spend in a 1031 exchange. They think they only have to reinvest their profit, where really you have to reinvest everything to fully defer your gain. So if you sold for $1 million, you need to buy a property at $1 million or more to fully defer your gain. You can go down in value, but you'll pay tax on the difference. Okay, so you want to make sure that whatever your plan is, that it makes sense from a tax perspective. And that's why I always recommend that our clients talk to their accountant before they do anything. Okay.
So, in other words, and just to make it clear, it doesn't mean that you cannot take cash out of that money. You have to invest the total amount and basically transfer that capital gains and the initial value of that property to the next one.
Right. So both your cost basis, which is your investment in the property, and your profit have to go into the next property to fully defer. If so if you sold at $1 million and you bought something for $800,000, you would pay tax roughly on $200,000, less closing costs. Okay. So that's why you want to make sure you plan. The other thing I always say is, we talked about the deadlines a little bit. We do have clients that that at the last minute decide to do a 1031 exchange. Well, that's not ideal, because if you decided at the closing table to do a 1031 exchange, first of all, my staff is not going to be happy with me when I tell them they have to process that order. They'll get it done. Lickety split. But we prefer to have a week to 2 weeks notice. But even more importantly, it also means you only started shopping the day you closed. And those 45 days, and you're in the industry, can you find a good property in 45 days? It's like, it's like starting the Indy 500 in reverse, right? So, you want to make sure you get moving quickly and find that. So lastly, I would say that you never want to buy a piece of garbage property just for the sake of deferring the taxes, right? You can lose a lot more than 30% buying a bad property than you can by paying taxes. And so, you want to make sure the property makes sense. That's the most important thing, in my opinion.
So let me ask you, as far as kind of syndication 1031, if you have a passive investor who wants to maybe sell a couple properties so that they could invest in a syndication, either as a limited partner or a general partner, would that be considered a correct 1031 exchange to a equal or greater value asset, or does it change the game?
Yeah, so syndication provides some challenges to 1031 exchanges, mostly because, as you said, your syndicated deals are typically set up in partnerships or limited liability companies. So you have a GP, a general partnership, or you can be a general partner or a limited partner. The problem in a 1031 exchange is you have to have the same taxpayer on each side of the exchange, which means the party that sells the relinquished property has to be the same party that's the tax owner of the replacement property. And buying into a partnership does not qualify. You actually have to have a property interest. So, to buy into your traditional syndicated deal as a 1031 investor doesn't make sense in that structure. So what we would typically see is that the syndicated entity could bring in 1031 money by having those 1031 investors come in as tenants in common in the property, which means that they would not invest in the limited liability company. They would actually buy a percentage interest in the property. Okay, so you might have, your syndicated entity might own 75% of the property, and your 1031 investor would come in and buy the remaining 25%, and they would hold that in a tenant in common relationship. Okay. And So I'm sorry. So the tricky part of that is, most syndicated deals, you have a syndicator, right? The syndicator's job is he finds the property, he or she finds the property. They line up the investors and they manage the property, and ultimately they help with the disposition of the sale. And they usually put in very or little capital into the transaction, right? Their contribution to the deal is usually sweat equity. And so they get a proportion of the profits, and they get an equity interest in the property so that they can get some of the upside appreciation on the sale. That doesn't work in a TIC structure because there's a revenue procedure that distinguishes between partnerships and tenants and common arrangements. And it says, amongst other things, that if you put 25% into a TIC deal, you got to get 25% of the profits. Okay. So, it basically goes against many of the things we try to accomplish in syndicated deals. So what we can typically do is, the syndicator can manage the entire property for both entities. The syndicator can earn a management fee that has to approach what the fair market value of the services are that they provide. And the syndicator can also be a manager of the limited liability company that the 1031 investor owns, which gives them some control over the voting rights, et cetera, that they may want in the deal. So typically that's the structure we look at for a 1031 in a syndicate.
Okay. Yeah, that's definitely interesting, because I know, some of our mentors, and the way we try to structure the syndication deal is we still provide interest in ownership. Yeah, it is with the entity LLC,
right,
not with the actual asset. So that makes it interesting. I was always curious about that, because I haven't really heard anyone hit on the 1031 for syndication. Traditionally it seems pretty standard, but thank you for that. That was
yeah, sure. And I always recommend, some of this, there is some gray area in there with the regard to whether the IRS respects those arrangements. So it's really important that if you're structuring that, you want to get a good tax advisor involved early in the process, to make sure that the structure, complies with the regulations.
Gotcha. Okay. No, that definitely makes sense as far as what we need to do to make it, obviously we want to do things right. We don't want to mess it up.
Right.
German, you have any question there?
I do. So I talk about a lot of investors in regards to the tax advantages that real estate have, right, compared to other investment assets. Can 1031 exchange be used for other assets besides real estate?
Yeah, unfortunately, no. So we used to do exchanges of other assets before 2017. When the Tax Cut and Jobs Act was passed, it actually eliminated exchanges of personal property. So we used to do exchanges of aircraft. We used to do exchanges of yachts. I actually did a $100 million yacht. It wasn't my $100 million yacht. For a client, we exchanged a $100 million yacht for a $150 million yacht. And that time I tried to convince them, as a qualified intermediary, I needed to make sure that those properties were like kind, right? So I needed to spend a week on each of them in the Caribbean. And ultimately they told me that I wasn't able to do that. And so I just had to basically look at pictures of these pretty boats, and that was it. But and even when we did personal property, it had to be like kind, which meant if you sold a plane, you had to buy a plane. If you sold artwork, a painting, you had to buy a painting. So they had to be like kind. So you can never go from one asset to you couldn't go from a painting and buy a piece of real estate. And so, but no longer, after January 1st, 2018, you could no longer do personal property exchanges.
Okay. What about stocks?
Stocks, likewise, you've never been able to do exchanges of stocks, unfortunately, for, stock investors.
Yeah.
It's a separate topic, and you may have already had people talk about this. That is one of the advantages and opportunities Zone has over 1031 exchanges, that people with inflated stock portfolios can sell that, take their capital gain, and invest in an opportunity zone. That's a whole another.
No, I wanted to just touch briefly on that, just because I have several conversations with day traders.
Okay.
And I tried to bring it up, and I just wanted to get it from an expert, that your opinion and your expertise on that. So yeah, I just wanted to briefly touch on that.
Yeah, sure. And that, I would, if they're interested in getting into real estate, they should look at the opportunity zone. That might be a good place for, day traders to go. Although the one problem a day trader has is they typically don't have capital gain because they're cycling their investments so quickly, right? So
Yeah,
if you're buying and selling in under a year, you don't have capital gain, you have income, and that's taxable.
exactly.
Yeah. So let me ask you this. So 1031 as a strategy for not paying tax. I mean, you can 1031, I mean, if you do it right, your whole life.
Yeah.
Right. And then, so then what happens when you get to the point and you accumulate enough wealth and say you pass away? Is there any kind of recapture? Is there, what's the strategy moving on from there to say, hey, I want to pass this on to the next generation and not have everything taken away again?
Yeah, it's a really useful technique. So if you do exchanges during the course of your lifetime, the gain keeps getting deferred and deferred and deferred, and hopefully you're buying bigger and more profitable properties along the way. If you then die owning the appreciated property, your estate gets a step up in cost basis and the capital gain disappears. That's under current tax laws. You always have to watch that.
Absolutely.
And then your state, you have to watch out for estate taxes because they can kind of bite you. But right now, the thresholds for estate taxes are very, very high, and so very few people will have to face that.
That's amazing. So essentially, the payment, the debt that you had to the government for capital gains is wiped.
Yeah.
And then now is essentially the investor should have already talked to an accountant or someone with the expertise to say, hey, how can I put this in an estate or some kind of trust to pass it down and not have it, or minimize the tax to the next generation?
Yeah, so good estate planning attorneys can help you get around those estate taxes or minimize them. In a 1031 exchange, you could also, let's say you had multiple children, you could buy multiple properties, right? And just leave a property to each kid and they can go their separate ways, which might be useful, in that situation. But we call that swapping until you drop.
I like it. I like the term. I really do. Yeah. And then as far as, partners having a property, either two or more and whatever percentage they own. What if one does not want to do a 1031? Is there any way, how does that work? Is there any way the one that does want to do it could force the other one to do it? Or can they, divide the income and then one doesn't, one does not? How would that?
So if they're in a true taxable tax partnership, typically a two-member limited liability company would be a partnership. It's very, the challenge is they cannot basically, they cannot just take the money in, one party does the exchange and the other doesn't, because they'll both wind up paying taxes, okay? So we have to get them out of the partnership, which means essentially they have to, basically we call this a swap and drop. Drop and swap. I got it backwards. So you drop out of the partnership into tenants in common, and then as tenants in common, you go your separate ways. Okay. The downside is the federal government used to challenge those transactions. It appears they're less interested in them, but some of the states like California and New York have continued to challenge these transactions. And so if possible, you want to do the drop out of the partnership before you go to contract to sell the property, or maybe even before you list the property. So it's a separate transaction and they're, from the actual sale of the property.
That's interesting. So it's a matter of changing your entity structure, correct? And then right before you sell to make sure you can take advantage of that. Okay. That seems pretty straightforward. Yeah, that's good. I had no idea you could do that. I thought once you were stuck on in a certain type of entity, you were stuck in it for a 1031. You couldn't just switch up out of nowhere. But
like I said, it's a little bit risky, and this does not work with S corporations or C corporations. Typically, it only really works with LLCs that are taxed as partnerships.
Got you. Okay. And then 1031s mainly used, well, not mainly used, but I imagine flippers use them a lot, right? Is that advantageous for them?
No, absolutely. Flippers, anybody who's doing the fix and flip should stay away from 1031 exchanges. This is property that's held for investment rather than resale. So if you're buying on Monday, fixing it up and selling it 2 months from now, that's not ideal. Or you should stay away from that. So there are a number of factors they look at, but holding period is the most evident factor the IRS will use to determine whether you're holding for an investment rather than resale. And it's generally recommended that if you hold the property for at least 2 years and rented it for that time, that it should qualify. If it's less than 2 years, maybe a year and a day, you get into the long-term capital gains rates at that point, so maybe that qualifies. But anything under a year, could invite scrutiny if they look at your tax return.
That's very interesting. So then, what would be an advantageous strategy for a flipper that they could do?
Yeah, ideally, there's really not a good 1031 strategy other than, fix it up, rent it, and then sell it, at least in the next tax year, if not longer. If you're just going to fix and flip and not do any kind of, holding, 1031's not it's not your tool.
Oh, wow. That's interesting. Yeah, Soren, a lot of flippers tell me they do 1031. So
that's entirely possible. It doesn't mean that, if they got audited, that it would be allowed. So there are a lot of people playing audit roulette, right? So, audits are very, very rare. Only 1% to 2% of all, taxpayers face random audits. And so people play audit roulette and they just take their chances and, the odds are in their favor. But if you do, the IRS would disallow it and you'd have to, fight with them.
So let's just tell the audience, don't do 1031 exchanges on flips.
Unless you want to assume the risk and fight that legal battle with the IRS, which no one wins, right? So
yeah, I always say once you get audited, you've probably already lost. But there are, real estate is full of cowboys, right? And as long as you have ammunition, you can go out as a gunslinger. But for the conservative investor, you want to kind of you want to do things a little bit more by the book.
Okay.
No,
and just to go clear on this, if you have an investment, a long-term investment, try to go past that first at least one tax year, right? Is that what you said?
Yeah, generally. And again, there's no set holding period and there's nothing I can tell you is absolutely safe. So it really depends on your total usage of the property. So, there's a lot of things in the tax code that suggest that 2 years, especially if you have the property rented for 2 years, or at least made the effort to rent for 2 years, that should be a pretty safe bet. If you're renting the property for a solid year, but and especially again, if you bought the property Monday, listed it on Tuesday, rented it out for 11 months, and got into the next year, that may not qualify because you've been trying to sell it for 11 months, right? So they look at everything if you get audited. But if you had solid rental and you get, I call this the Godfather defense, you get the offer you couldn't refuse, right? Your intention was to hold the property long-term and to rent it forever. And some guy who comes along and offers you double what you bought the property for, well, you should not necessarily be penalized for that. It was unsolicited, and I think you have pretty good facts there.
That's a great point. And what about short-term rentals, which are so in common right now?
I'm sorry? Short-term rentals? Oh, your Airbnbs? Yeah. Yeah, so that should qualify. So, as long as really what you look at, if you have a property and you're holding it and you're doing the Airbnb thing, I don't see that you have a problem qualifying that as being held for investment, provided you are not using the property yourself for personal purposes.
Okay. You got it.
If you do, then you have to look, there's a vacation home safe harbor under, I'm going to throw out some legal jargon here, Rev Proc 2008-16, okay, which basically says you can exchange vacation homes, but you have to hold them for at least 2 years before the sale. So that's the first, again, we're looking at 2 years. And in those 2 years, you must each year rent the property at least 14 days to another person at a fair market rent and use the property no more than 14 days or 10% of the time it's rented. I want to back up a second because I think I said that wrong. 14 days of rental minimum, and use it no more than 14 days or 10% of the time it's rented. That makes sense?
Got it. Yes, it makes sense. So in the case of those people that are renting their homes, right? They live in their homes, but they're renting different rooms in their houses.
Right.
It does not count.
If you're renting,
1031 exchange.
yeah. So if you're renting different rooms in your house, you want to really keep good records of that, and you should not be using those rooms when you're not renting them, right? So, this is comparable to, my grandparents came over to this country in the 50s, and they bought a 6-family house in an area in Queens called Ridgewood. And they rented out those 5 units, and they raised 8 children in one of those apartments. Don't ask me how, but they did. If they sold that property, they would be able to exclude a portion of their gain as their primary residence because they lived in it forever. And they could have done a 1031 exchange on the other 5 units. Okay, so that's clean because you have separate dwelling units. In something like an Airbnb, you really, if you're going to try to do a 1031 exchange, it would only be on the value of the rooms that you used for rental purposes. And so you'd have to kind of get an appraisal based on the square footage and determine what the value of that was. And you can conceivably do an exchange on those rooms and then, exclude from the exchange the portion of the property that you lived in.
Got it. Would that be the same case now, not short term, but let's say, for example, somebody who has a big property, right? And they rent long-term different parts of that property. Let's say, for example, they have a shed outside where they rent it for storage or different rooms of their house long-term.
Yeah.
Would that be the same case where they have to bring somebody to, okay.
Yeah, absolutely. That works. So, the example of that you see in the regulations are farmland, right? So if somebody, lives in the farmhouse, but they rent out the farmland to, 10 farmers, the farmland qualifies for 1031 exchanges. Likewise, a storage shed or, whatever you're doing. Even, we've had people who buy a house in a college town. So they know their kids are going to go to college at, wherever, Harvard, whatever, that's a big example, but, and so they might buy a house and rent it out to a bunch of college students. And one of those students might be their own kid. Right. So ideally your kid would be paying rent, but we both kind of know that's not realistic. So, to the extent that any value is attributed to where your child lives, if they're not paying rent, that wouldn't qualify. But to the other tenants, it could qualify.
That's very interesting.
Yeah. And there were different strategies there.
Yeah.
Some cool things you could do. We also have people doing this. Let's say I have a client that had a factory here in New York where I am, and I think he made plastic bags. And if you look, plastic bags are not very popular these days. So seeing that he sold his factory, it's in an area of Brooklyn, which is being developed, and sold that factory. He bought a bunch of different properties, including a rental house in Florida. Okay. And his plan was he'll rent it out for a period of time, but then when he's ready, that's where he's going to retire. So he'll move down there, and essentially he's acquired his retirement house through a 1031 exchange. And you can do that. You want to make sure that you rent it long enough, which, at least 2 years, I'd suggest. And then he'll move down
there. That is really smart.
Yeah.
Yeah, it's really smart. Yeah. Because, you can get your home, get it all set up, maybe even rent it out for a bit, short-term rental in Florida.
Right.
Second home, whatever you want it to be. That's awesome.
As long as you have the patience to rent to people, right? So, a lot of people don't want to deal with the 3 T's, those tenants, the trash, and the toilets. But if you have the stamina to be able to do that for a couple of years, then it makes sense.
Yeah, no, that's pretty awesome. So let me ask you about you. I imagine you've used 1031 on some of your assets or investments?
Yeah, I've used it. The downside is I cannot be my own qualified intermediary, so I've had to work with other people. But I'm not a huge property holder, but I've had a couple. So 1031's been useful in that respect. It's a useful tool, and it helps kind of knowing the basics.
Okay, no, that's perfect. Let's see here. Anything you would recommend off the bat to someone who isn't as familiar with 1031s as far as resources do or don'ts?
Yeah, so we have a wealth of information on our website, which is Madison 1031.com. We have a blog there called the 1031 Zone, where I post articles about once a month or so. So that's a good resource for people. Certainly, if you're thinking about doing a 1031 exchange, you want to start doing homework early. And so I recommend having a good conversation with the qualified intermediary early in the process, because we take you through kind of some of the ropes. We can kind of look at some of your plans and, tell you where there might be problems. And also, you have to get your accountant involved as early as possible. I can't stress that enough. A good accountant can make or break any type of tax transaction. And so we love to work with our clients' accountants to make sure that they're in good hands.
Gotcha. Perfect.
I have a question in regards to professional qualifications to become a qualified intermediary. How does one become one?
Yeah. So as I think when we were talking earlier, when I heard the term, as a young attorney, I did a 1031 exchange for somebody, and I racked my brains trying to figure out how this whole process works. And so they told me about qualified intermediary. And I breathed a sigh of relief thinking, oh, here's somebody who's qualified, right? This person must have some special training. Maybe they went to qualified intermediary school, which is located next to Clown College, someplace. And they got the Good Housekeeping seal of approval from the IRS saying they're qualified. So none of that's required. As we said, we're an unregulated industry by and large. And so really you just have to pass the pulse test, right? They take your pulse. And if you have a pulse, you can be a qualified intermediary. So, but what you cannot do is you cannot be a qualified intermediary if you are the agent of the taxpayer who's doing the exchange. So that's why I cannot be my own qualified intermediary. My own company cannot be my qualified intermediary. My attorney, my accountant, those people cannot be your qualified intermediary.
Got it. Okay. Makes sense.
Yeah, no, that works perfectly. Well, we want to thank you so much for coming on the show and explaining this all to us and to the audience. It really was, I learned tons on here, so I appreciate it.
Oh, you're welcome.
And could you, for the audience, I know you already mentioned Madison1031.com, but any other way they can reach you or social media?
Yeah, sure. You can find me on LinkedIn. I'm on LinkedIn. I forget exactly the designation, but look at Michael Brady. I pop up in the top 5, especially if you put Michael Brady 1031. I might be the only one. You might get that guy from the Brady Bunch too. He might pop up, but so beware of that. I'm not that guy. My email address, you can always send me emails to mbrady, like the Brady Bunch, at madison1031.com. I answer a lot of questions. I'm a resource for a lot of people, and I'm more than happy to do that.
Awesome. Well, thank you so much for coming on the show. And if you're tuning in, please subscribe either on the YouTube or iTunes, Spotify, you name it. We're on it. So thank you so much.
Yeah, thanks, guys.
Thank you, Michael. Have a good one.
You too.